What a week we have ahead of us. The second quarter earnings season will be at its busiest in America, and no less than a third of the FTSE 100 is due to publish results, release a trading update, or host an annual general meeting. So where do we start? Well, that will be actually with the US Federal Reserve, whose latest monetary policy decision is due on Wednesday, the 29th of July. Chair Jay Powell has already made it clear that the American Central Bank is in no rush to raise interest rates from their record low of 0.25%, but he's been equally forthright that he's no desire to take rates into negative territory. That suggests that quantitative easing and the Fed's legion of other acronyms and bond buying programs are central to policy planning, as the central bank does its best to help America get through the pandemic. Note that the first estimate for American GDP growth in the second quarter of the year is due the day after the Fed statement on Thursday the 30th. I'm sure they'll have a sneak look. But the Atlanta Fed GDP Now survey is looking for an annualised decline of almost 35%. Remember that the Fed is currently holding its base interest rate at 0.25%, while its balance sheet currently holds around $7 trillion of assets, up from just over $4 trillion at the start of the year. Do keep an eye on that balance sheet, because the Fed has stopped growing its assets. Initially, that seemed to slow down the recovery in America's S&P 500 index, although the benchmark's still heading high now all the same, at least at the time of recording. Back home, corporate news is likely to dominate, especially as the first half results season's fast approaching. After around a dozen names last week, over 30 FTSE 100 firms are updating shareholders on their financial performance in the coming week, and a lot of mid-caps will be doing the same. Names which may be worthy of note include the following, either for what the statements say about the firms themselves, their industry, or indeed the wider economy. On Tuesday the 28th of July, we've got Dettol producer Reckitt Benckiser, silver miner Fresnillo, snack seller Greggs, and Virgin Money UK. They will be followed by drug giant GlaxoSmithKline, retailer Next, house builder Taylor Wimpey, Smith & Nephew, and Wizz Air on the 29th. On the 30th, the spotlight may belong to another pharmaceuticals firm, AstraZeneca, as well as oil major Royal Dutch Shell, the banks, Lloyds and Standard Chartered, and miner Anglo-American. And then on Friday the 31st, the grand finale, well, that features BT, British American Tobacco, International and Consolidated Airlines, miner and trader Glencore, and Royal Bank of Scotland. But the biggest source of a fuss in the week ahead could be another bank, Barclays. The high street lender to Wall Street investment banking firm is due to report its first half results on Wednesday the 29th of July. Barclays shares may be up by more than 40% from their spring lows, but they're still down by around a quarter over the past year, a little bit worse than the FTSE 100, which is down by around a sixth. Now, investors have been concerned about 5 issues in particular at Barclays, but it's by no means unique to it amongst the banking sector. First, how QE and record low interest rates seem to be squeezing lending margins. Second, whether a recession could lead to a jump in bad loans, as it has for the major American banks, for example. Barclays has already taken a £2.1 billion charge of its own for potential loan losses in the first quarter of this year. Third, whether the investment banking arm really can cut the mustard up against the American megabanks. To give Barclays its due, this unit performed strongly in the first quarter, and it really should have made hay between April and June too. Fourth, corporate governance issues at Barclays, and fifth and finally, the regulator's decision to lean on the big 5 FTSE 100 banks and effectively ban them from paying dividends or buying back shares in calendar 2020. This could still give Barclays a little bit of wiggle room to declare and pay some form of dividend for calendar 2020 alongside its fourth quarter results in early 2021, should management feel this is appropriate. That may explain why analysts still believe Barclays will offer a 2 pence per share dividend for fiscal 2020, ahead of a rebound to 6.1 pence in 2021, although there will definitely be no interim dividend this year. The first half statement from Barclays will be scrutinised for all of these points and more, although if the second quarter numbers from the American banks are any guide, lower lending margins, higher loan losses, and a strong investment banking performance are all likely trends. They should feed into the headline pre-tax profit figure, where, at the time of recording, the analyst's consensus estimate is for a pre-tax profit of £491 million for the second quarter. That's well down from £1.5 billion in the second quarter of last year, and even £913 million in Q1 of this year. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you next week.